live from Music City, Nashville, Tennessee. This is your motivational, sensational, inspirational, educational, keenly awaited, highly anticipated edition of Real Life Trading, the newbie class. Class number 2. How you guys doing? Let's see. There's a poll open. Do you guys have it? All right, you just now see it. Okay. You just now saw the poll. So I had it open before class, but I did not know if you guys could see it before class or not. I'm taking that as a no. Alan, I'm doing sensational, my good sir. Thank you for asking. All right, I'm going to keep this poll open for 5 more seconds. 5 more? 5, 4, 3, 2, 1. This is just kind of a fun survey. See what you guys think. Thank you for participation and votes. All right. How do I share the survey? Share. Where is it? Here's the results of what you guys think. Wow, 30 and 30 for the Cowboys and the Bears. Lydia Barbosa, a.k.a. half of the Gapettes, says that the Bears are going to win. I think the Cowboys are going to win. Anyway, just figured I would kind of throw that in there, see what you guys think, see what you guys thought overall. Let me go ahead and share my screen. Jeffrey White, how are you? Sally! Hello, Sally! Sally in the house. All right. It is not a class without Sally. Oh, love it. Love it, love it. Well, ladies and gentlemen, most of you who are here might have found the link to class from an email that I sent you. Maybe you're on the website and you clicked on the Are You a Noob? Noob, by the way, is a slang term for newbie, which is also a slang term for a beginner trader. Now, I know some of you aren't necessarily beginners, right? Maybe you are been following us on TradingView or Twitter or Facebook or LinkedIn, or you subscribe on YouTube. Maybe you've traded for a while, but you might be here just simply because you're not the most profitable trader, or maybe you've been grinding it out and you kind of want to know what's going wrong. So tonight's class, in my opinion, is a sensational class. Sensational! It's called risk mitigation. You see, in my opinion, some of the most important aspects of trading would be trading your plan. So, having a plan, but trading your plan, risk mitigation, discipline, patience. They all kind of get wrapped in together, I guess. But I mean, those 4 right there. You have those 4, and you can trade. Simple as that. You have those 4 and you can trade. Crazy as that sounds, right? It's really not that wildly difficult. Sometimes you'll see me spell the word patience like this. P-A-Y. Patience, yeah. Changing it up a little bit because, yes, if you are patient in the market, you can get paid. So as a review, since we do have a lot of brand new students here, Adam's a new student. Tiffany, Gloria, Jasmine, Marcuccio, that's an awesome name. How are you? Don Hasseltine, George, Gushamara, that's an awesome name. Mr. Vincent, Bob, glad to have you here. So risk mitigation, phenomenally important. And many companies will charge an arm and a leg for this information. Well, I'm not going to. So here we go. As a review, support is a price where a stock bounces and it finds more buying pressure than selling pressure. Resistance is a price where a stock finds more selling pressure than buying pressure. And when you create these support and resistance lines and prices, they give you an area so that you can create your plan and have an idea of what you want to do and why. So, ladies and gentlemen, notice right here, Microsoft had a resistance, right, at $28.50. So, Tiffany, answer me this question. So, it was a resistance at that location. What about right here? What was that line now? Lorenzo! How you doing, Lorenzo? How you doing? All right, Wayne Usher got it correct. Beautiful. Troy Beinhauer, what's up, gangster? Barry, very nice. So, yeah, absolutely. Jan, you're absolutely correct. George, you're absolutely correct. Chris Birch, absolutely correct. So, that was an old resistance, right? Now it became a support. It's almost like if you're a kid and you found a hole in the attic, right? You went up through the hole, and now you can walk on top of the attic. You know, you guys have done that before, right? Get inside the attic. So at one point, the attic's a resistance. So you call the ceiling. But once you get into the attic, now the floor of the ceiling becomes a support. So that's the way it works, right? Old resistance becomes new support, and vice versa. If the stock broke through supports, old support would become new resistance. All right. So let's talk about some rules for support and resistance. My good friend William Robertson. Let's talk about a few rules. If you want to write these down, you're more than welcome to. I like these rules. To get a good support and resistance, it's where a stock should stop, pause, or bounce from that price. All right. The more times the stock touches the line, the stronger that price point. 6 to 8 lines is all you really need on your chart. I know that's much bigger than most people, much smaller than most people have. Type in a 1 if you're guilty, right? So we had a beginner class Tuesday. Type in a 1 if you started going on your chart and in TradingView and you have like 1,000 lines on your chart now. You really only need 6 to 8. You don't need that many. I mean, if you have 100 different lines, the question becomes which one's the most important? Which one do you use if you have 100 of them? So just find the strongest ones. Find the major points. And if you want to make it simple, feel free to get the extreme high and the extreme low of the chart first, just so you can kind of, boom, you have that idea. You can begin using either a daily or a weekly chart. On a daily chart, look at the past 4 to 5 years and look for areas of what's called white space. I'll show you what that means in just a second. But white space kind of helps you determine strong support and resistance areas even faster. And you can use either a candlestick chart or a line chart. Line charts are easier for my beginners, my fresh new traders out there in the world. If you're a brand new trader, line charts are a little bit easier for you. So let's go find examples of white space. So I can kind of show an example of what this looks like. It's almost so obvious, it's painful. But I had a student who had issues recognizing support and resistance. And this student just could not see what good support and resistance was. And as a good teacher, I didn't get frustrated. I just had to realize that, this person might think differently. So I had to come up with a way of showing this person how they can create support and resistance better with their mind's eye. Because if you ever have trouble finding out which support and resistance lines are best for you, look for something called white space. White space. White space is where there's not any data. There's nothing there. It's just white. So notice there's no data right here. Would you guys agree that this green blob, there is no lines of any kind in that area? It's just pure white space. Oops, I went too far. I'll go back. Give me 3 seconds. Don't know how I did that. So notice there's no price data. There's no price data up here. So what if I drew a line that looks like this? Beep. Is that one? What do you guys think? Is that a pretty decent line? Yes or no? Yeah, it's not too shabby. Is this an example of white space, students? Yes or no? What do you guys think? Is that an example of white space? Yeah, it's an example of white space. There's nothing there. Okay, so there's nothing there. We can draw a resistance line. Looks a little bit like this. And notice how well that line works out. And this line. And that's pretty much all you need on Microsoft. Those 3 lines that I just drew. That's it. That's all you need. All right, not too shabby. So you just kind of look where the data isn't. And sometimes that'll help you instead of looking where the data is. Now, here's a very valid question that I had. Elizabeth emailed me after class that we had recently when I taught the first class of Real Life Trading Live. And she asked me, Jeremy, how in the world do we select a company to trade? How do we select a company to chart? I think that's a valid question. How, with all of the stocks out in the world, How do we choose what to do? Well, I can break it down pretty easy for you. Choose a company that you interact with on a day-to-day basis. Make sure the company is over $5 and has more than 1 million shares traded on average. And you can look at the million shares, on Yahoo Finance or, kind of anything. But Apple is an example. Facebook, Microsoft, Google, Ford, GM, Panera, Chipotle, IBM, Chipotle again, because I'm hungry often, Target, Disney, Walmart, Starbucks, Netflix. All companies that you interact with on a day-to-day basis. Right? All of those are companies that you guys have interacted with or talked with or used or whatever. You guys have all interacted with companies like that on a day-to-day basis. Those are just fine. You don't have to go and try to find some random pharmaceutical company or some off-the-wall biotechnology company that might triple in value. You can make money in the market trading companies that you know all the time. The really, really cool website that we built, reallifetrading.com, we built that off of an Apple trade. Specifically, just a few Apple trades. You don't have to trade some random, crazy, off-the-wall company. Just trade Apple or Facebook or Google or Microsoft, right? Disney, Netflix. Frank Manade, a real-life trader, just absolutely destroyed Netflix like 2 or 3 weeks ago. Just destroyed it, which is good. Another question that I often get, right when I get to this level, is can you scan for stocks? And the answer is yes, you can. You're more than welcome to scan for stocks. Here are scanners that you can use. Here's some examples. I don't have a partnership with this company yet, but you're more than welcome to use them. Finviz.com. They are a good scanner. They're solid. You can use your broker. Your broker oftentimes has scanners, of all kinds. There are plenty of live trading rooms out there. Real Life Trading has one of them from 1 to 4 Eastern Standard Time, Monday through Friday. And also other analysts out in the world, they can give you ideas. So there are all kinds of ideas out there. But you have to remember, ladies and gentlemen, that less is more when you begin to trade effectively. You can hunt and hunt all you want, but it's easier and less stressful to begin small. Because my thought process is, if you can't make 2 trades a month and make those profitable, Sally, what makes you think you can do 20 trades a month? Think about that. Think about that for just one moment. You see, when I first started trading, I was trying to do 12 or 10 trades a month, something like that. And I wasn't really making any money. And so I thought to myself, and type in a 1 in the chat pane if you kind of thought this as well. But I thought to myself, I'm not making any money. There has to be more and more opportunities out there. So since I'm not making money, I should trade more. That's what I should do. I should trade more. I should buy more shares and buy more options and be more active because obviously there's more opportunities out there that I'm missing that I'm not getting a hold of. So you have to think about that. So again, if you can't do 12 trades profitable, what makes you think you can do 20? So my advice is try to do as few as possible and see if you can begin to make profit on as little trades as possible. Because the market rewards the specialists. Or again, if you can't do 2 trades profitable a month, you can't do 20 trades profitable a month. Unfortunately. Right? It's all about us. It's all about you as traders. So, once you find the stock that you trade, either if it's through a broker, because again, there's nothing wrong with using scanners. You just have to know what you're looking for and know how to trade your plan. And always remember, in trading, less is more. I promise you. Less is more. Once you find the stock, how do you buy it? What do you do? Well, let's look at an example. This is a stock called ExxonMobil. It's a company. You guys have all heard of ExxonMobil, every one of you. How many touches does ExxonMobil have on this particular line? Remember, this is white space all down here. All of this is white space. And notice, there's one line on this chart. One line. How many touches did it get? So let's see. Here's about one or two over here. Here's one over here, and here's one over there. So let's just call it 3, 3.5. 3 1/3. I mean, you can call it 3 7/3, which is technically like 5.5 or something, but whatever. You guys get the idea. There's a lot of touches there. So this is a line chart. All right, this is a line chart. And this is over, Barry, since you asked earlier, this is over a few years. So this is 3 years on the chart. So oftentimes when looking at support and resistance, as I mentioned earlier, 3 to 5 years on a daily chart is really sufficient. So here's an example of a candlestick chart, and you'll notice we get many more touches on ExxonMobil. So we got 2 or 3 over here. We have an additional one here, an additional one here, one here, and one here. So now we have like 5 plus using the candlestick chart. So what we're going to do now, boys and girls, is we're going to zoom in to approximately right there on ExxonMobil. Right about there. I'm going to zoom in. Here we go. So riddle me this, and again, my new students, if you can help me out with that, it would be great. The brand news, the newbies out there in the world. What type of candlestick pattern is this? Ed Reed, what do you think, my good friend? This is your type of stock. You love ExxonMobil's, good blue chip, good dividend paying stocks. Harry Anderson, what do you think? Janet, how do you pronounce your last name, Janet? Metrigger. I'm gonna butcher that. I'm just gonna stop. What type of candlestick pattern is that? We talked about it on our last live class. Yep. I would refer to that as a one white soldier. One white soldier. Why? Why is it a one white soldier? Pretty simple. It is a white candle, which is preceded by a black candle. And the white candle opened and closed above the prior day black candle's close. So here's the open of the white candle. Here's the close of the white candle. And here's the close of the prior day. So it opened and closed above the prior day black candle's close. You're going to hear me say that a lot. So how would you buy this particular trade? We're going to zoom in just a little bit more. On the one white soldier pattern, remember, the one white soldier pattern that I'm referring to is bouncing off of a support. So what you have to do first is find a company. Number 2, draw the lines. Number 3, find the support. And number 4, wait for a one white soldier to bounce off of the support. Ladies and gentlemen, riddle me this. Let's say you choose a company. Let's say that company is, Panera. And you draw some support and resistance lines on Panera. And Panera is not at a support. The stock is not coming down to a support and bouncing. What would you do? If your plan was to wait for the stock to come down and support and buy with a one white soldier, what do you do if Panera is not doing that? Wait for it. Wait for it. Yeah, you wait. Just wait. So if you do find a company that you are looking at and you see the support and you draw the support and the stock does eventually come down to support, which at some point it likely will, and you see a one white soldier candle pattern, here's what you do, ladies and gentlemen. You find the high of the one white soldier candle pattern, and as the stock moves above the high, you buy to open. Buy to open what, you might ask? Let's keep it as simple as possible. Buy to open shares of ExxonMobil. How do you buy to open? You have to go into the broker. We're going to be talking about broker next in the next live class, which is in this case Tuesday, 9 p.m. Eastern of next week. So that's the class 3 is the tools. Class 3 is the how do you do this. Because remember, this is geared towards my brand new beginning traders who may have never traded the market before. And even those who have traded the market before, you got to keep it simple. It's simple, simple, simple. The simpler it is, the easier it is. And the easier it is, the quicker you can do it. And the quicker you can do it, the more time you have to do other things, like go play some golf. Do you guys remember, or have you seen those puzzles? Type in a 5 if you know what I'm talking about. Those puzzles that are really, like the kids' puzzles, they have like 6 pieces to them, and they're really, really huge. And it's like, okay, it's a guy's face over here, and like the arm over here, and, you know, it's a big square, and the puzzle looks like this. And there's like 3, 5, 6 pieces. And you can put them together in like 20 seconds. Right? You know what I'm talking about? I mean, they're usually a kid's puzzle. How quick are those to put together? Well, they're quick for most of us. I hope so. Right? A minute or so, and you've got it. But if it's a 1,000-piece puzzle, it's going to take a lot longer. So, again, what I'm saying is, when we were kids, we all were taught the basics first, and the basics were hounded and burned into our brains, and then we began to get the more complex items. The exact same way that trading is. Figure out the way to make some additional money with the really, really, really easy stuff. Stick to that. Pay off your debts. Pay off your credit cards. Take some money aside. Pay the tax man. Buy some real estate. You guys get the idea. That's what real life trading is all about. Right? Take your spouse out on a nice dinner. Buy some champagne. Take the dog out to the park. Get him a new collar. Buy the cat a really good cat food, whatever they eat. See what I'm saying? That's it. That's what you do. Buy low, sell high. Find a stock off of support. One white soldier, phenomenal pattern. Buy to open. So let's do an example. The first person who throws a stock out gets it. Who it is? Eric Moss. Thanks, man. I appreciate that. Pat Kavek says AMAT. No idea what that is, but I'm pulling it up. AMAT. I'm pulling up in real life trading. Great sites. Jim Oliveira. What's up, brother? Joseph Smith. I think that's the one that I'm going to do at some point tonight. Don't let me forget. Okay. So applied materials. Ooh, I have all kinds of things that just popped up. All kinds of things. Let me see if I can make that simpler. Give me 3 seconds on AMAT. Let's see how I can make that less intense. I'm still a smidge new on TradingView. I've only been using it for about 3-4 months. But I can do it. There we go. I'll just hide all the indicators. I don't want to confuse you guys yet with indicators. Matter of fact, I don't really have any classes at all on indicators on the site right now. So let's do this really quick. Let's just draw some support and resistance lines based on what we just talked about. Okay, so we're going to get about 4 to 5 years of data on our chart. And let's do a line chart because, again, line charts are easy. Let's get 4 to 5 years on our chart. I'm going to zoom out. And again, in TradingView, this is insanely simple. If you have a mouse, you just kind of scroll and the data will zoom out, and then you go ahead and over here and pick your lines. It's really that easy. All right, so come over here. You guys have any questions so far? Any questions? I think TradingView is freezing down a little bit. It's trying to keep up with me. Sometimes computers have a hard time keeping up with my mouse. I can go pretty ferociously quick sometimes. Hey, what's up, Warner? Hope you're doing well, man. Hope you're doing well. Give me about 17 seconds. Sorry for the pause. I think it's my internet connection. It might be the internet connection. It's a little slow. I think I have too many Britney Spears songs on my computer. Joke. That's totally a joke. I don't have any Britney Spears songs on my computer to slow it down. That's no way. I would never do that. All right. So let's go get some lines. So go ahead and throw out some prices for me, my good friends. Throw out some prices for me. What we have. So we have right now about 3 years on the chart. Do we have any support and resistance lines that we can see? Any support resistance? All right, Steve Smith says 19-ish. Yep, 19-ish is a very good one right there. Right about here at 19 is a very, very good one. 23 is a really, really good one. So at the moment, we don't need to draw a cornucopia of lines because we can see where the stock is at. Per the strategy that I've been going over with you so far in tonight's class, is this stock a prime candidate for what we've been talking about? Buy low, sell high. Is this thing just like OMG? What an amazing buy low, sell high opportunity for us real life traders. Wow, this is like a snail carrying a jar of molasses uphill through a brick wall during a snowstorm. That is slow. Slow. All right, so Barry says that it is at all-time highs. Yes, that's absolutely correct. It is indeed at all-time highs. So the 23 resistance line, is that a support now, yes or no? What do you guys think? This 2316 line that's on my chart, is that, so it's old resistance, new support. Okay, so we're not totally lost. We're not just out of the woods, because here's what could happen on AMT. What if AMT trades down to 2316 and bounces? What could we do? What can we do? Well, if it does that, then, if we get, again, if our trading plan is to, all right, buy the bounce off of a support with a one white soldier, what can we do? And the answer is we could buy the bounce. Yeah, we could wait for it. So at this particular point in time, we just don't really do anything. Right, so here's two supports. So let me go ahead and turn candles on if I'm able to, if it allows me. I think I'm gonna try to open it up in another tab. How do I do this? Here we go. Give me about 23 seconds. Eric says, now I get to go play golf. Yeah, go play some golf. Go play some golf, right? Just wait. You have your plan. Now you wait for what's going on. So here it is. It's a little bit faster. There we go. All right. So answer me a few questions on AMT. So here's a support, the exact same support you guys just talked about, and here's our resistance. So let's come up with two questions, and I want two answers from the audience. First question, based on what I've taught you so far, is this a support line, yes or no? I mean, you guys chose it. Okay. Is this a one white soldier candle, yes or no? The answer is, yes it is. It meets the exact definition. Right, the exact definition. There's a black candle, and now there's a white candle that opened and closed above the prior day black candle's close. One white soldier. Over here, in this particular candle, we have a black candle. Black candle came down, and there was a white candle that opened and closed above the prior day black candle's close. So you had at least the determination, the understanding to be more bullish than bearish. From this location, here's a resistance. So again, ladies and gentlemen, could we have a plan in the future, that says if the stock comes down to this old resistance, new support, and bounces with a one white soldier, could we buy it? Yes or no? Can I get a hallelujah from the audience, ladies and gentlemen? Yeah, it's that simple. So now we're controlling the market rather than the market controlling us. We are saying, hey, this is what I want it to do. This is what I expect it to do. Now, here's the key. What if it does not do it? Ha ha ha! What a good question, Charleston. What if the stock does not do it? What should we do then? What could we do in this situation? Don't do anything. Just leave it alone. Just leave it alone. It's like that really pretty girl named Ashley in the bar who won't talk to you. Just leave her alone. Okay? Just be patient. Just leave it alone. Because there's nothing you can do. Right? You can't control the market. If you try to control the market, you'll lose. I don't want you to control the market. I want you to control you. That's all I want. I want you to control you. Let's do one more. And maybe this trade just might help you pay for this class. Oh, wait, this class is free. Maybe this... I knew that going into this. Anyway. Maybe this trade will just help you go, oh, how fascinating. So here's X, United States Steel. You guys ever heard of this trade? Ever heard of this company? It's been around for a long, long time. Long time. So what do you guys think? Are we out of support? Yes or no? Adam, what do you think, brother? Are we out of support? I don't know. Let's find out. So this is a resistance. This is a support that we've bounced off of before and made a good, $10 move. And we're back to it. We're back to the exact same location. So question number 2. Is it a buy low, sell high territory? Answer to that question is yes. All right. Question number 3. Is this a one white soldier? And the answer is... That was my Santa Claus impression. This is a gift from Santa himself. Yes, it is a one white soldier. Absolutely. So what should we do? What do we do in this instance? Oh, I don't know. I don't know. How about we say to ourselves, okay, I want this stock to go above 3309. Why 3309? Well, it's a little bit above the wicks of those candles. So here's the support, and if it bounces, can we get into the trade? Yeah, we can. So what should we do now? Well, if we have a plan, now comes something very interesting. You might remember the name of this class is called Risk Mitigation. Let's talk about stops. Let's talk about stops. Baby, you and me, let's talk about stop something. I don't know how that song goes. I don't know who sings that song. S is for the way you smile at me. All right, I'll stop. How do you determine your stop? How do you determine your stop? What a phenomenal question this is. What a phenomenal question. Ladies and gentlemen, there are literally countless schools of thought on risk mitigation, stop placement, amount of risks, blah, blah, blah. I mean, it goes on. There are books, there are webinars, there are pages and pages of just literature. There are entire companies built on just this one simple premise. I'll put it to you this way. I know what works and what doesn't work because I'm a real-life professional trader. I know in trading and in life, consistency and discipline are essential for maximum growth. Jim Rohn said discipline is the bridge between goals and accomplishment. So if you know where you are and you know where you want to be, In order to get from here to here, you have to have discipline. Simple as that. You can have anything that you want, but you've got to be disciplined. I am here to say I don't really mind what school of thought you do in regards to stops. It doesn't really bother me if you have a different perspective or opinion than I have. I'm going to teach you my opinion. I'm going to show you how it works. And I will tell you this. It works as long as you let it work. If you screw it up, there's nothing I can do. You got to be disciplined. Who is ready to be disciplined? That's all you have to do. You follow this and you do it, it works. You can choose anything that works. You just have to do it. We all know push-ups work. Push-ups get you in shape. The question is, do you do them? We all know what works, ladies and gentlemen. The 3 key factors in stops are location, consistency, and how long you plan on being in the trade. We'll get to that in just a little bit later. But in my opinion, those are the 3 key factors. If you go into a trade with your plan and you expect to be in the trade longer, you can be more gratuitous with your stop. So if you go in and you say to yourself, all right, I like X. I want to be in the stop a little bit longer. Well, you can be a little bit more gratuitous in that situation. Location, consistency are huge. So let's talk about this. Here is the exact ExxonMobil example we were talking about just a moment ago. We buy to open, right? Location. When you are bouncing off support, place the stop under current support level and place below prior day's low. Here is where you would place your stop. Your stop is called the sell to close. That's how you would exit the trade. That's how you exit. You sell to close. So when you get into the trade, you buy to open, and when you place your stop, you sell to close. So notice how my stop is below the support level, and it gives me some white space. White space is a term you'll hear me use, and it really is more art than science. When I say give it some white space, okay, it means in all scenarios, give the trade a little bit of room to be wrong. Do you guys see how my buy to open, there is some white space between the one white soldier and the trigger? Do you guys see that? And the sell to close, there's a little bit of white space between the candles and the actual stop itself. That takes a little bit of practice, but it's great to use. Just give it a little bit of wiggle room. Okay? We'll do some more examples. Here's an example of Microsoft. Here's a buy to open location. Notice this is a one white soldier. Buy to open. So again, when buying off of support, place the stop below the current support level and below the prior day's low. So notice I did not draw a line on the support level. But ladies and gentlemen, can you see Microsoft support from the prior data? Can you guys see that? Here it is right here. So when placing your stop, place your stop below the support levels and below the prior candle's low. So here's the prior candle's low right there. Place your stop below that. Atom, BTO stands for buy to open. STC stands for sell to close. So if you buy shares of Microsoft here, you place your stop in order to sell them there. So here's a random question, guys. If you get into this trade, are you now protected in case the stock does this? Yes or no? See ya, Jim. That's hilarious. Are you protected? Yeah. Yeah, you're protected. Right, Jan? You are. You are protected, my good friend. If the stock just absolutely crumbles, you have a location where you can sell the stock. Okay? You can at least sell it. You can exit it. You can stop the bleeding. You can stop the pain, so to speak. You have something that can get you out of the trade. That's a big deal. It's a really big deal. Here's First Solar. So notice, ladies and gentlemen, this line was a resistance back in 2011. It was a resistance back in 2013, kind of a resistance right there, a resistance right there, and it was support back here in 2014. This was a real life trade that some of myself and real life traders did. Let's zoom in, and ladies and gentlemen, do you see the one white soldier? I remember this trade like it was yesterday. It wasn't that long ago. It was back in July, but this particular trade, the only two things I used to do this trade, and it was a really, really good trade. The only two things we did was candlesticks and the support line. That was it. Candlesticks and the support. But Jeremy, what about... No, it was just those two things. That was it. Remember the puzzle? Two pieces are much easier to put together than 1,000. Candlesticks and support line. So Adam, what did we do? Well, the entry was the buy to open. The stop placement was placed right there below the prior candle's low and below the support. That was the location where you would sell to close your position. There you go. There you go. Oh, it's so gorgeous. So pretty. Yeah, that was a fun little trade. That was a few car payments right there. And hey, that's what real life is about, right? Trade, buy low, sell high, pay off your car, get out of debt. You know, get that TV that you want or whatever. Simple. So here's a fascinating question. How do we stay consistent? My dad used to tell me this. He says, son, if you want to be consistent, simply be consistent. I was like, wow, Dad. Wow. Oh man. Oh my goodness. What a concept. But I mean, if you really think about it, that's how you're consistent. You just simply be consistent. That's really all there is to it. So be consistent. How do you be consistent? Simply be consistent. Keep risk the same value. Only take the best trades. I really like what Jesse Owens said. I'm sure you guys know who Jesse Owens is. Jesse Owens has a quote. He says, "We all have dreams, but in order to make dreams come into reality, it takes an awful lot of determination, dedication, self-discipline, and effort." Ladies and gentlemen, if you can be consistent, you can be disciplined. And when you're disciplined in the market, what are you? Who can tell me? If you can be consistent, you can be disciplined. The two are very similar. And if you can be disciplined in the market, you will be profitable. Profitable. Money. That's it. So let me help you be a little bit more consistent in your risk. Let's talk about consistency and trading the R's. What is an R? Oh, what a question. I get this question all the time because I talk about it in the live trading room. I talk about it on Twitter, talk about it on Facebook when we post a trade or whatever. What is an R? An R is an abbreviated letter for risk unit. Risk unit. That's what an R is, Eric Moss. A trader must become a master of risk management in order to break through to the professional level of trading. The quickest and most real way for a trader to become consistently profitable is to trade to acquire skill. The best way to accomplish this is to measure your trading results based on risk units rather than returns on investment. It's about measuring and mastering risk. Here's a Jeremy Newsom quote you guys can write down in your little booklets if you want. If you don't have money, you won't have money to trade. So if you lose all of your money, you won't have any money to trade. Keep your money around. Protect it. Protect this house. Protect the profits. Protect your trades. So my goal is for you to break through of a fear of losing money. I know a lot of you guys, no one can see your comments right now unless we pass them along. Type in a 3 if you're a little bit afraid of losing money. Just give me some 3s. Who's afraid of losing money? Okay? Don't be. Don't be afraid of losing money. If you're afraid of losing money, it's probably because you don't know how much you're going to lose. And that's why you're afraid. Because you don't know how much you're going to lose. You lose money every time you buy something. Is that true? Yes or no? Verify that with me. You lose money every time you buy something. I mean, it's gone. It's gone from your wallet or your bank account. It flutters away. Every time you go to Starbucks and you buy your double chocolate chip frappuccino venti style, your $5.46 just it's gone. That's losing money in my world. I don't want you guys to think about trading money any longer. Take money out of your mind. When you look at the market, do you see money or do you see risk management possibilities? Warren Buffett is able to trade billions of dollars at a time because he's not concerned about money. He's not trading money. He is trading R's. He's trading risk. In order to become a professional trader, my friends, you have to lose the fear of losing money. You have to. Have to. If you typed in a 3 and you have a fear of losing money, you have to break through that fear. And the only way to do it is to stop trading money and to start trading risk units. So Ryan, hang in there, because I'll tell you in just a second. I'm going to get to you. So ladies and gentlemen, I have no fear of losing money. I really don't. If you ever meet me in real life, I have zero fear of losing money. I just don't. Right? It doesn't exist. I don't care if it's $1, $100, $1,000, $10,000, $1 million. I don't care. It doesn't. It's just they're just paper. It's just paper. It's all money is. Don't worry about losing money, ladies and gentlemen. You're only trading R's. What is an R? An R is the amount that you are okay with losing on a trade. Ryan. So Ryan Simpson, you're going to lose on trades. In the investment world, you're going to win some and you're going to lose some. Simple as that. There should never be an instance in a trade when the stop price is not determined before getting into this trade. You should know every trade you take where your stop is going to be. My friends, please know that stops are not your enemy. Some people hate getting stopped out. Do not hate getting stopped out. They're like the brakes to your car. You guys all like the brakes to your car, don't you? Yeah, you probably do. You're probably a big fan of the brakes on your car. That's what stops are. Your stop price keeps you from losing more than your R on a losing trade. Upon entering the trade, you should have completely accepted the possibility of the maximum loss on your R. And if your R is too big to lose, then you should decrease it. So your R must always be the same amount for each trade taken over a predetermined amount of trading days, and picking different risks for each trade will never lead a trader to longer-term consistently and consistent profitability. Let me guys give you an example. Certainty with risk. Ladies and gentlemen, when we're trading, certainty is such a huge aspect of our trading because it helps us, sleep better at night if you really think about it. When I talked about just a moment ago the fear of losing money, in order to not have a fear of losing money, it really helps when you understand and you are certain exactly how much you are going to lose. So let's say Devin is an amateur trader, and Devin is bullish on GMC, the car manufacturer, and he risks $9.75 and he makes $9.75. And then now he's bullish on a second trade, GNC this time, the vitamin company. He risks $9.75 and this trade he gains $9.75. And then he goes bearish on the QQQs and he risks $9.75 and he makes $9.75. Well, so he has 3 trades in a row that make him some money. He's feeling pretty good about it. He's up almost $3,000. and he sees a really good trade on Verizon. He's like, oh yeah, Verizon's going to the moon. They had a really, really cute girl in their commercial, and I know that people are going to buy this product. So he buys a lot. He risks $6,000. Well, on this particular trade, he loses that investment. He loses his $6,000. So his take-home pay in this scenario is negative $3,075, even though he is a 75% accurate trader. Ladies and gentlemen, that's a huge batting average, 75%. I mean, remember and keep in mind that trading is not about winning or losing. You're going to lose on trades. You're going to lose a lot on trades. I mean, sometimes 50-50. Every other trade you might lose. It's not about losing. It's about controlling your risk and keeping your money around to trade longer. An exact example would be Sam. Let's say in this example, Sam, who's a real-life professional trader, risks the exact same amount of money on each trade. He makes $450. He makes on Hawaiian Airlines. He makes $450 on Plug. He makes $450 on Alcoa. And then, again, the fourth trade, again, he's a 3 out of 4 trader, so 75% batting average. He goes bullish on X, and he loses. No big deal. It happens. Mitigates your risk. So he loses $450. The exact same win-loss ratio, different companies, obviously, but the take-home pay, simply because he kept his risk the exact same, he made $900 on this example instead of losing $3,000, simply because, again, he was mitigating his risk so that the one trade he did lose on didn't just absolutely blow him out of the water. So the benefits of trading the R's is it keeps you consistent. Believe it or not, it removes the emotion of money. It limits your losses to a certain predetermined amount. My friends, when you go into a trade and you know exactly how much you're going to lose on the trade, it helps you sleep better at night. It helps you build the muscle of consistency. Oh, and in the future, you can increase your R over time. So let's say 4 months go by and you have a $150 R and you just traded like a rock star. All 4 months, you trade your plan, you mitigated your risk like a champion, and you're profitable at the end of 4 months. What do you guys think? Could you increase your R? Yeah, maybe email me, maybe talk to a real-life trading coach or someone and just say, hey, I've done this, this, and this. What do you think? Should I increase my R? My account's now grown. And we're like, yeah, sure, increase your R. So now from 150, now it goes up to 200. And you just slowly start climbing up the scale. Oh, and it prevents you from blowing out your account. Right? It prevents it from just losing it. So as a trader, it's very, very hard to be certain in the stock market. Certainty is one of our biggest human needs. This gives you that need so you feel less stressed out when you trade. Remember, your notes, no one can see them. Type in a 4 if you feel stressed out in your trades right now, like the ones in your account right now. I'm not talking about 9 years ago. I'm not talking about 10 years from now. I'm talking about right now. Are you stressed out about the trades that you take that are in your account that you're trading? If you're stressed out, it's because you're uncertain. Uncertainty is one of your human needs. Because you do not know how much you're going to lose and you do not know how much you're going to make, and it stresses you out. I'm just telling you because I've been there. I know because it's happened to me. I know because I used to have to take many, many different types of pills to sleep at night because I had no idea if Tuesday morning I was going to wake up at a $60,000 loss or a $69,000 gain or a $10,000 gain or a $100 loss. I mean, I have no idea. I have no idea what's going on. No clue. Well then, how in the world do you figure out how much you should risk? Well, the R strategy purely is just a calculation. I mean, you could use any letter, any number, anything you want to create, but realistically, the R strategy just stands for risk, right? Your risk unit. So a trader's risk unit should not exceed 2% of their cash account value. For example, let's say you had a $5,536.79 account. Okay. In that scenario, your R would be $100.10.73 if you're exact about it, but obviously it could be rounded down to 110. So you don't have to necessarily factor in the cents. I mean, you can. Let's say, for example, you had a $16,000 account. Your R will be 320. If you have a smaller account, $1,958 account, your R, $39.16. It could be rounded up to 40, or it could be rounded down to 39. And that's kind of your decision. The cents aren't that massively important, but realistically, you just simply have to know how much your risk is. You have to understand and know that on any given trade, you have the opportunity of losing money. You gotta risk money to make money. You gotta invest money in order to gain more. And realistically, if you have a small account, if you have a $1,950 account, it's going to take time. It might take a lot less than others starting out with a $1,958 account. But if you have a smaller account, it's going to take time. Simple as that. There is no magical pill, unfortunately. I wish if there was, I would sell it. I'd find a license and I'd sell that magical pill. But there really isn't any magical pill available. We just have to be patient. We have to be patient, we have to be disciplined, and we have to understand that losses are going to occur. And at some point, you want to limit your losses on a weekly, daily basis, monthly maybe, yearly, quarterly, whatever. And that's what really comes down to your trading plan, building that in. We're going to talk about this in the future. This is more of a day trading plan, specifically. But regardless, limit your losses per trade to 1R. If you want to come up with losses per week and losses per month, I will help you do that in class 4 next week. But this is a really, really good day trading time for good day trading plan to have. Okay. So your maximum R value is the amount that you should lose, is crucial and very important to trading your plan. Okay. So, here's how you determine how many shares or contracts to buy. So, let me go up and see if Ryan Simpson typed in his R, because he's trying to figure out how this whole thing works. George Murphy says, do you include trade costs? Nope. No, sir. That's just part of doing business. Part of doing business. Don't even worry about that. Ryan Simpson, where you at, man? You said you don't understand this. I need to help you out. What's your R? I mean, you need to work. We need to do it. What is the R? Ryan said, not active right now. It's okay. No worries. Give me an amount, and let's practice so that when you are active, you're ready. Give me an R. All right, so $50. So a $50 R. Let's say you have a 25-cent stop. That's 200 shares. Ladies and gentlemen, how many contracts does that control? How many contracts does that control? 2. If you don't know what contracts are, we'll get to that later. But it really is that stupid simple. You don't really have to stress yourself out about delta, giant formulas. It's really that simple. Use your R and you divide your stop value. So if you had a $50 R and you had a $2 stop, that's 25 shares or 0 contracts. Maybe you could do 1, but preferably 0 because 25 shares, you know what I'm saying? 1 contract controls 100 shares. If you had a $100 R and you had $1 stop, you have 100 shares. So this is the math behind it. So to determine your R, you divide your R by the size of your stop. That's what you do. You divide your R by the size of your stop. So here's the formula. R divided by stop amount. Okay? So let's look at this example and let's draw in a little bit of a support line right here. And let's say on this particular stock, this is Hawaiian Airlines, you had a buy signal on that one white soldier and your stop was there. Let's just do the calculations, okay? All I want us to do is do the calculations. So you bought in at $14.50, your stop was $12.50, and your R is $50. How many shares? Go. So Alex, I'm answering that question right now. So this is your stop. What is your stop value? So Alex, go ahead and calculate. How many shares are we talking about right now? So your R divided by your stop value. Stop value is obviously, Alex, the difference between where you bought it and where your stop is. So the answer, 25. Alex, very good job. Chris, beautiful. Jan, Teresa, you guys all got that right. Very nice. Roshan, very good. Curtis, yep, you're absolutely right. 25 shares. Is that a lot? I mean, no. If you have a $50 R, it's really not that much. But that's not the point. The point is to become consistent. If you can become consistent, you become disciplined. If you can become disciplined, you can become profitable. So Jesse, I just answered that question on the last slide. So if you can control 25 shares, how many options contracts is that, Jesse? How many option contracts is that? 0. So you don't do it. Simple as that. If one contract controls 100 shares and you can only trade 25 shares, don't take this trade. You get it? It really is that easy. That is it. Oh, by the way, is this a one white soldier right here? Yes or no? Oh, no worries, Jesse. You're fine, bro. You're fine, bruh. Yes, that was indeed a one white soldier on Hawaiian Airlines. Yep. Absolutely. Let's do one more. Let's do a different R this time. Same exact trade. Okay, we're being consistent. So it doesn't matter. This is just for math. This is for example, so you guys can get it. So let's say you bought to open the stock at $14.50. Your stop was at $12.50, and your R is 300. How many shares? Jan, that is correct. Yep, that is absolutely correct. How many shares? So Jan, I want you to ask me. Yeah, beautiful. There you go, Jan. Perfect. Wow, that was really quick, man. So Jan answered his own question. So he was asking about the options as well. So he said 150 shares or one contract at the max 2. One contract at the max 2. Yep, Brian, beautiful job, bro. 1 at the max 2. Very good. Yeah, heck yeah, that's awesome. That's awesome. Very good. So you guys get the idea. I mean, that's really how it works. Let's do it. Let's do another one. Let's find that one right there. You guys can probably see the one white soldier on that particular trade. But again, let's just calculate the R value. So here's our stop, and here's the place that we're going to buy it. So our stop is below support. We bought it above the one white soldier. So again, let's just practice the math here. Let's say you buy to open at 13, your stop is 9, and your R is 300. How many shares would you buy in this scenario? So George, so you come up with your stop value. Stop value is the difference between these two numbers, and you divide that out of 300. Adam, yeah, Adam, there you go, buddy. Very good, very good. So in this scenario, yeah, it's 75 shares. 75 shares. Now, as we progress and get a little bit better with our strategy, right? So remember, this is the simple thing. This is the part that's really, 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 really easy. So we're going to focus on making the easy thing even easier. But as we progress as real-life professional traders, I'm going to teach you about this little move right here, this gap. This gap is a very, very bullish gap, and I'm going to teach you how to actually get in right here at the open of that gap. So instead of your risk reward being there, your risk reward would actually be here, from here to here. So it'd be a much, much better risk reward. So all of this is just pure profit. It's called a gap and go. I'll be teaching you guys that in the future. Don't worry. And yes, I'll explain exactly how it works. I'll get all of that, but let's keep it simple right now. Super simple. Because if we're looking at this, compared to the screen, guys, is this a really large risk? On the screen, that thing is big. That thing is really big. George, the other way around. 300 divided by 4, brother. 300 divided by 4. Sally said it's a really big risk on the chart. Yes, it is a really, really big risk on the chart. Yep. So let's talk a little bit about risk to reward ratio. Risk to reward ratio is semi-self-explanatory. How much are you risking and how much might you make? So, ladies and gentlemen, should you risk 1R to gain 1R? Yes or no? Is that a good strategy? The answer is no. No, you really don't want to do that. You do not want to do that. You do not want to risk 1R to gain 1R or risk $1 to gain $1. See, Adam, in the investing world, my friend, you always want to get more than you're investing. Always. That's your goal. You always want to get more than you're investing. If we're discussing risk certainty and risk reward ratio, let's look at Gary and Lisa. Gary and Lisa are two different traders. And in this example, Gary is talking and focusing a little bit more on risk reward ratio, but he ends up risking more than he should. But still is focused on risk-reward ratio. So I'll kind of show you the two differences. So if Gary, he's understanding good risk-reward ratio metrics. So always you want to get more than you are risking. So his first trade, he goes bullish on Apple. He risks $55. He has a 1-to-3 risk-reward ratio, and he gains $165. Trade number 2, he's bullish on Facebook, but he does lose on that particular trade. Therefore, he had a 1-to-1 risk-reward ratio. So he lost his one risk unit on that trade. Third trade, he goes bearish on AT&T. He risks $55, and he ends up getting a 1-to-2 risk-reward ratio, and he gains himself 110 smackaroonies. Number 4, Gary, the trade, he goes bullish on silver. Well, unfortunately, silver kind of tanks, and he risked $275. And even though he had a 1-to-1 risk-reward ratio, the risk value was different. His take-home pay, negative $55. If we hop over to Lisa, we can see that Lisa kept her risk the exact same on every trade, $150. Boom, 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 boom. And she did have good risk to reward ratios. She kept that in mind. So instead of simply selling at a 1-to-1 on a profitable trade, she realized to make even more money, you simply exit at minimum, your risk on the trade. So if she risks 150 on CSX, she's going for a double of her investment, 1-to-2 risk reward ratio. So risk 150, gains 300. Lisa goes bullish on Office Depot. Well, Office Depot did not go up. So she lost 150 on that trade. Trade number 3, Lisa is bearish on AT&T. So notice the exact same trade. So bearish on AT&T. Gary made money and Lisa made money, exact same trade. They both had a 1-to-2 risk-reward ratio. Great for them. They're probably in some really, really cool live trading room, maybe called the trading floor. I'm not sure, but either way, they both made money on that trade. And then number 4, they lost on SPY. But again, keep in mind, Gary went on silver, Lisa did on SPY. She risked 150, but had the exact same risk on every trade, 1-to-1, and she lost to 150. Being a 50-50 trader, meaning 2 out of 4 trades, a 50-50, which I truly believe everyone who is listening to my sound of my voice at this moment is and can be a 50-50 trader with good risk mitigation principles and good risk to reward ratios and having your risk certain. You can be profitable trading the market. And this was an example of a $300 gain being just a 50-50 trader for Lisa. So here's that exact chart, but over to the left a little bit, where we have a good one white soldier off of support. So let's do the math one more time, and this time let's bring in risk to reward ratio. So notice in this example, you buy to open at $10 a share, you place your stop at $9 a share, and your R is 300. That will be 300 shares or 3 contracts that you would buy in the trade. What do you do from here? How about make it so easy that you can do it in seconds? Would you guys like that? Here it is. If your stop value is $1 in price, how about you just simply multiply it times 2 or times 3? I mean, that would get you a 2-to-1 or 3-to-1 risk-to-reward ratio, right? So if you bought in at $10 and your stop is $1, multiply it times 2. 2 plus 10 is 12. There's target number 1. That is a 1-to-2 risk-to-reward ratio. That's simple. 1-to-2. And I'll just tell you straight up, guys, being a 50-50 trader, which pretty much everyone here probably is. You all are probably 50-50 traders, believe it or not. Being a 50-50 trader and just doing a 1-to-2 risk-reward ratio, you can make money. So peg, find out your stop value and multiply it by 2 or 3 or 4 or 5, whatever your target, whatever you want it to be, whatever you want your risk to reward to be. That's simple. Just multiply it. So in this example, this is another real life trade that I did. Okay, this was on EA Games. And this is just an example. This is not based on the one white soldier strategy, but this one is down here. Oops, I'm sorry. Let me go back. Oh, snapdragons. I can't go back. Yes, I can. He will. He will and he can. All right, here you go. So here it is. Here's the stop, and here's the location that I bought it. There's the stop, and there's the buy. So look over this for about 4 seconds, and then I'm going to hop out over here, and then I'm going to ask you on that trade, what ended up happening on this one right here. So the green line was my entry, and the red line was my stop. I'm going to do a poll. I want you guys just to tell me what ended up happening on my trade that I did, my real life trade. What ended up happening? Poll time. Where's that poll? Here it is. Poll and open. What happened on that trade? Give me 1 second. Where'd it go? Sorry, I'm usually a little bit more flexible than that. Can you guys see it? I don't think you can. Oh, snuffleupagus. Why isn't it working? There. I think it's open now. See if you guys can vote.
Now it is.
Yeah, I don't know what was going on. Sorry, Ange. So for my students watching the recording, I'll bring this up. This is the poll. What happened on that trade that I just showed out? Okay, so you guys are voting. I'll let you guys vote for 5, 4, 3, 2, 1 in voting, and I'll share the results. 43% said I got stopped out and I lost 1 R. Well, I'm a professional trader, ladies and gentlemen, and I'm never wrong. Okay, I can always manage the trade, and I can always no, I got stopped out. Got into the trade, got stopped out. So Adam, my friend, how much did I lose on this trade? How much did I lose on the trade? I lost an R, just like you guys said. That was it. 1 R loss. So I went back a few weeks later. Ladies and gentlemen, is that a one white soldier candle? Yes or no? Is that a one white soldier candle? Yes, sir. Yes, sir. And so my entry, I bought, let's say at 35. Stop was at 33. Peg, can you give me a 2R target? What was the 2R target? What do you guys think? Sally said, why didn't you get out the first shoulder? I don't know what you're talking about. Right here? I mean, this is hindsight. So, I mean, the stock went up, went down. I thought it was going to continue like that. I didn't know it was going to stop down. Sally says, I don't get where you're on this chart. Right here where it says buy and it says stop. So, if we had buy at 35 and we had a stop at 33, where is our 2R target? Well, the difference between that is $2. So if we wanted a 2R target, we multiply 2 times 2 and get 4. We take 4 and we make it $39. $39, which is beautiful because it coincides very interestingly with that resistance right there, the last time the stock sold off. What do you guys think? Did the trade work out? Did that trade work out? That exact one? Well, let's hop over to EA Games and let's find out. So, hop over here. EA. Give me about 7 seconds to pull up EA. EA Games. Here's EA Games. EA Games. Boom. The high on EA Games was 38.39. Started getting some reversal signals, and at that point, you could have taken your stop, which was initially here, and we'll talk about that in the future. Move it up somewhere, and you would have gotten stopped out, trailed out. You would make a little bit of profit. Very, very close to your target. Few pennies away. That's up. That's okay. Worst case scenario. You'd have gotten stopped out down here if you held the entire time for 1R loss. But, again, based on some principles I'm going to be teaching you guys in the future, you'd have been able to lock in some profit or at least mitigate your loss, at least so that you have zero loss, 0R. 0R. That's kind of the goal. The goal is to not lose. So here's a very valid question. On that exact entry then on EA Games, the question becomes, how long do you want to be in that trade? How long? Because if you want to be in the trade long, you can, again, be a little bit more gratuitous with your stop. So let's discuss for just a moment before I send you guys off into your beautiful night's sleep. Let's talk about the 4 lengths of trading in my eyes. You have day trading, which I do often. I love day trading. We have a live day trading room, 1 to 4 Eastern, Monday through Friday. I'll have it tomorrow, live from Gainesville, Florida. So there's day trading. So you're going to be in that trade minutes to hours, sometimes seconds. You're not in it long. Then you have swing trading, which is days to months. Core trading, which is weeks to years. And then you have what I call life trading. Life trading. You can easily build a quick trading plan for each time frame of trading, and in my opinion, you should. The team at Real Life Trading are experts on all 4 lengths of trading time frames. So let's just talk about day trading for a moment. We do have at Real Life Trading an amazing program that goes into day trading for free. Okay. Day trading has many rules and regulations that you need to follow. I mean, that's just a simple behind it. And day trading, and here's something that most people won't tell you, but day trading is the best way to consistently carve profits from the market. So if you're looking to make money monthly from the market, day trading is probably the answer. Swing trading, you sometimes won't make money every single month. I mean, the honest truth of the matter is there's 12 months in the year, and ladies and gentlemen, out of those 12 months, 3 months, I absolutely destroy it. The other 9 months, I'm either breaking even, the stocks aren't doing anything, it's flatlining, like not much is going on, I'm making a little bit here, I'm making a little bit there. But that's really the truth. I mean, in swing trading, you can't just trade because you need to make money. Swing trading takes time. Day trading is the best way, in my opinion, to consistently carve out profits from the market. Swing trading is great. I love swing trading. I'm all about it. But there will be times where it'll be good, and there will be times where it'll be really, really boring. Simple as that. In day trading, you don't care about long-term possession of the stock. You do not care about fundamentals whatsoever. You do not care. And day trading is based entirely on technicals, and it is a challenge, but it's well worth it. Angie just posted the link to our day trading page. It's entirely free. Thankfully, if you want to learn how to day trade, we will teach you how to day trade for free. Crazy, huh? Wild. Wild. So if you're watching this recording video and you're not in class, simply come to reallifetraining.com and right at the top, click on day trading. And that's a full program. That's not, oh, hey, but if you want to buy this, you have to, if you really, really, really want to learn how to day trade, you got to buy this class. No. Forget that. All of this, that's what you need to know. In 4 classes, I can teach you how to day trade. Crazy as it sounds. Sounds nuts, I know. Sounds like no other company would even imagine doing that because they could make so much money on selling these classes. It's true. I could make a lot of money selling these classes. I'm not about that. It's not my thing. I can make money trading. So, yeah. I figured I'd give it to all of you guys. Let me give it to the world so we can enrich lives. Chris said, do you feel one must master swing trading before one can master day trading? Nope. It's a great question, Chris, but I truly don't believe so. You ready for this? You have to master you, brother. You have to master you before you can master anything. And I say that seriously about, trading your plan, being consistent, being disciplined. You can trade anything you want. Anything you want as long as you stick to your plan and you just do it. So swing trading, as Chris is talking about, is designed for the more active trader. Swing trading is based 99% more on technicals. If you know information or you like the company, that's a plus. So Adam, if you like Panera Bread or Lulu or Netflix or whatever, yeah, that's cool. There's nothing wrong with that. Stops are much more loose than in day trading. In day trading, you're going to have stops like 10 cents big. They're not going to be very large. And swing trading is great for either bullish, bearish, or neutral markets. I like swing trading. I prefer day trading, guys. I like day trading. My swing trades are very, very good. I'm all about swing tradings, but day trading is the best way to carve out profits. And by the way, Real Life Trading is one of the few companies out there that talk about something called proprietary trading. This is going to be in the future. I just want to let you guys know, but I'm going to have more courses on this. I have some courses now, but I'm going to teach you how to day trade with $2,500. Not $25,000 like's required, but $2,500. How cool is that? I mean, it's already on the website now if you want to watch it, but I'm just saying, I'll have a live program in the future about day trading with $2,500. Pretty dope. Pretty cool. So, core trading. Let's just talk a little bit about that. Core trading is designed more for the longer term trader. It's based 80% or more on technicals. It's a good thing to know a little bit more of the company. It's best for bullish trades. Core trading, you're not going to be trading in years on a bearish trade. Right? There's not going to be years. So core trades are for bullish trades. Because in a core trade, you're going to be in that. You're going to be in that trade for 9 months sometimes. 9, 10, 11 months, years, 5, 6, 7 years. You're going to be in that trade a while. And there's nothing wrong with that. So if you're doing a core trade, the stops are usually more loose, right? They're great. Core trading is great for traders who work full time, who are retired or approaching retirement. It's also great for newer traders, but does require a little bit of patience. And by a little bit, I mean a lot. So core trading is just go out and buy a company. Just go out and just buy some shares and let it do its thing if you're buying off support. It requires patience. Trades often take a minimum of 3 months to work out. And ladies and gentlemen, this is when you get some really, really high risk to reward ratios, like 1 to 12. Those are the type of risk reward ratios that most people dream about, 1 to 12. I mean, you're in that trade for a while. That makes sense? You guys got it? So if you're doing core trading, it's great to know and understand options, to use options as leverage. I will agree. So doing covered calls, collars, things of that nature works very, very well for core trading. Life trading, this is something that many people don't talk about, but life trading is great for any type of trader, in my opinion. These trades aren't actively traded specifically. Risk is, of course, considered, but it's not a huge factor on trades like these. Trades are typically 10 years or more. 10 years or more. So examples of life trades, I mean, you have stocks and college funds. You're talking about annuities, mutual funds. Maybe it's a company that you work for or a company you have ownership in. Or maybe it's a stock that you want to donate or pass along to your children or grandchildren. So you're not going to actively trade these things. Technicals are used, sure, but dollar cost averaging definitely comes into play. You're going to need to know some information about the company. These stocks usually should pay dividends, and in my honest opinion, it should be a company or product or mission that you at least believe in. So if you're doing a life trade, I mean, those trades are forever. All right? Forever. So in additional future classes at Real Life Trading, we're going to learn more about the strategies that can be implemented for each type of trading. So day trading, that's really, Real Life Trading is focused a lot on day trading. We're focused on day trading and how it can change, your financial future. So that's our main focus. Our main focus is day trading, swing trading, and core trading. That's really what our goal is, to teach you and to enrich lives and things of that nature, so that we can help you guys understand that. So Ryan says, do you cover any fibs? Oh, Ryan Simpson. Looks like you need to take a quick vacation through the website, brother. If you click on Master of Trading right here, you'll hop over here, and in class 10, 11, 12, I talk more about 10, 11, I talk about fibs and Elliott Wave. Also for free. Ba 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 da da da. Pretty cool. Ladies and gentlemen, any questions? We're pretty much done. That's it. Any questions from the audience? I have a quiz before you guys go. I'm going to do a quiz for you guys. Here's what I want you to do between this class and the next class we teach live. Tell everyone you can about real life trading. I'm serious. We're real, right? We are real. Our mission is to enrich lives. Please help us achieve that mission. Let anyone at any time know that we can be, what we can do to better serve you. If you ever have any questions, concerns, thoughts, anything you need, you can email us anytime at support@reallifetrading.com. Warner says, please, one more time, what is the difference between stop and limit? I haven't discussed limits, Warner, in tonight's class at all. I can help you with them. A limit order, let me hop over to the chart really quick. Okay. So there are many different types of limit orders, but I'm assuming you're asking about stop limit orders. Warner? I'm assuming that's what you're wondering about. Let me show you what a stop limit order is. A stop limit order is saying, okay, at $32 or more, I want to exit this trade. Okay? 32 or more. So let's say, for example, the stock is going down and the stock gaps down to $31.99 and keeps falling. Would you sell your position, Warner? Yes or no? And the answer is no. You would not. Because a stop limit says, okay, at this price, get me out, but I want it to sell at this price or higher. That's what a stop limit price is. Okay? So that's all. That's what a stop limit is. I mean, that's it. So I never use stop limits because sometimes they don't work. You know, they can be skipped. That's why I just use hardcore stops. From there, you have limit sell and you have limit buy, which are pretty self-explanatory. Limit buy says, okay, I want to buy this stock at $32 or less. So if the stock reaches $32, like right here, it reached $31.77 was the low, you would have bought EA Games on that candle if you had a limit buy order of 32. Because limit buy says I want to buy something at this price or lower. If you have a sell limit of, let's just say, hypothetically, $38.50. Let's say you have a sell limit at $38.50, Warner, and the stock gaps up to $39. Do you sell at $38.50 or do you sell at $39? Sally, that is correct. No notebooks, dear. No notebooks. And Warner, you're correct. $39 is the price that you sell. Because when you sell at a limit, you are saying, I want to sell at that price or higher. I want to sell at that price or higher. That's pretty much all limits are. So let's go back really quick and look at X and set up this trade. And ladies and gentlemen, what do you guys agree? Do you agree with my stop right there? Yes or no? Based on what we just talked about. Based on what we talked about tonight, does that stop work? Yes or no? Okay. I mean, it's a one white soldier bouncing off support, entry, exit. Okay. So if our entry is 3302, this is a real life example. Again, one of the reasons I call my company Real Life Trading. How awesome is that? 3302 minus 3063. This is a real life trade. What's the stop value, Adam? Give it to me, brother. What is it, ladies and gentlemen? What is the stop value? Might have to do a little bit of calculator on this one. 3302 minus 3063 equals $2.39. So all of you wrote in already your R's for tonight. All of you already wrote it in. Go ahead and tell me then, based on your R, how many shares is that? My R is 600. So I'm going to say 600 divided by 239 equals 251 shares. Okay. So write in how many shares you can buy based on your R. Then from here, all you have to do is take your stop value, multiply it times 2 or 3 or 4, whatever number suits your fancy. I mean, it's totally your decision. Doesn't bother me either way. 239 times, and let's just say 2 is 478. 478 plus our entry price is 3780. 3780 can be target number 1. 3780. And at 3780, you really can do whatever you want. I mean, you can do You can exit, half of your position. You can exit all of your position. You can take your stop up and put it to break even and continue to hold. You can exit a quarter. I mean, that's really all about your website. Or your website. That's all about your trading plan. I'll teach you more strategies in the future, but really at that point, anything you do can work. As long as you're making more money than you're risking, I don't really care what you do. It can all work. Okay? So if you enter, stop, target, boom, boom, so on and so forth. There you go. There you go. Teresa said, can you put in your stop and at the same time you enter your target? The answer is yes, but it does depend on your broker. Jan says, when do you move the stop to break even? Jan, that's up to you, brother. That is up to you. Personally, I like to move my stop to break even once we reach 1 or 2R, depending on how fast it happens. 1 or 2R, I'll move my stop to break even. Usually 2R. So, there you go. There's a real-life trade setup, ladies and gentlemen. It'll be interesting to see if this does indeed work out, if it triggers, what it does. That'll be very, very fascinating to see. All right, so let's go ahead and let's open you guys up the quiz. I want to see how you guys do in the quiz. You guys ready? Who's ready for a quiz? Yeah, quiz time. All right. Here it is, and I'm going to open it. Go. Hold on. I think someone's pressing something. Angie, are you it's not you. I don't know what it is, but I'm pressing something that's not showing it. Maybe that'll work. All right. So for my recording students, I'll let you guys look it out. So go ahead. Students who are watching this as a recording, what does R stand for? That's question number 1. Now you guys are doing question number 2. Oh, this is cool. Ryan said, quiz, not prepared at all. Oh, no. Oh, no. Oh, no. All right. So you guys are looking through this, taking a quiz. So my students watching the recording, don't you wish you were here live? It's so fun. Awesome. You guys are fast. And I know, if you're not the best test takers, it's okay. It's all right. I won't hold it open for too long. But you guys are doing very, very well. I can see you guys thinking. Literally, I can see you thinking. I can see you thinking. Just doing it again. I'm trying to continue to see you guys think. I'm glad I'm recording this. I'm going to send this to Click Webinar, Ange. Bum, bum, ba-da-da-da. All right. I'm going to have to end the survey in a second. It's breaking the internet. I'm breaking the internet, ladies and gentlemen. Internet's like, I don't know what to do. Oh, no. Oh, no, Clarence. What should we do? Let me try to just simply share the results. That will be a good thing to do. I kind of want share results. All right, so you guys should all be getting your results now, I hope. I think you can see your results, or at least I'm trying to. Oh, Click Webinar. You're so good sometimes. You're so good sometimes. Oh, well.
That's so odd. It keeps flashing
Yeah.
on and off.
Let's see if you guys... So there's
Frustrating.
the results. Maybe you guys can see those results. I can. If you guys can't see them, I can see them. And what it means to me is that you guys did well. Ryan said I got 6 and 6 when it flashed. Cool. Cool. Maybe we're trying to break the internet. Maybe there's never been a test for 127 people. That's how many people are here tonight. I love it. Anyway, ladies and gentlemen, here's what I want to say. Regardless, tech issues or not, internet issues or not, we are all real life traders. And I do, in fact, honestly appreciate you being here. I hope that you share this class, this video, this information, this energy, this enthusiasm, this mission with people. Simply let them know. Tell them, spread the word. There's no sales pitches. There's no schemes. There's no gimmicks. It's education, ladies and gentlemen. That's how you shape the world. That's how you change the world. You give yourself onto others. Giving is better than receiving. Treat others the way you want to be treated. All that kind of good stuff. The gold rule, so on and so forth. So before we leave, I want to leave you with one quote. I might try to do this in every class. Don't hold me to it. But I do want to give you. I want to share a quote with you before we leave. A little bit of a motivational quote, and then we'll send you guys off to snooze land. This was written by Brendan Bouchard in what's called the Motivational Manifesto. I believe it's a new book. He says, "If we have dreams, then we must fight for them. For the sake of our soul and our families, we must adopt that hunger and that warrior spirit. The warrior spirit that is hungry, ambitious, and courageous. The essence of the warrior spirit is readiness, a bias towards action. Warriors do not waste time in making decisions. There is little hesitation, hemming, hawing, or hedging. Warriors do not await perfect circumstances to begin the long march to victory. No, they do not stop when they are tired or frightened. They do not shy away from a need to fight. They do not apologize for boldness or strength. No, when there is a conquest, ladies and gentlemen, when they see the fortune in the lands of the horizon, they set out. They march. They march. And they march." Ladies and gentlemen, I love you guys all. Have a great weekend. I'll see you next week for the live class 3. And until then, remember, love life, live life, and trade it. Welcome to Real Life Trading.